Bank for making this possible, and also our presenters here from Baker Tilly. We have a lot of material I think we're going to cover, so we're going to get started, but I'd like to introduce Pete Wautlet from Baker Tilly. He's a senior partner at the firm.
I don't know about that senior part, but I am a partner at Baker Tilly. I want to join Derek in thanking both WCEDA for hosting this event and Town Bank for being the presenting sponsor. Again, my name's Pete Wautlet from Baker Tilly. We're going to talk about tax reform today. A lot of changes in the tax reform law. A lot of opportunity too, and that's what we want to talk about today. We've kind of split it up into kind of 5 pieces. I've got some of my co-workers here, and I'll introduce them. But a lot to go through, a lot of opportunity. Hopefully you guys learned something today, and hopefully we can help. Wanted to tell you a little bit about Baker Tilly. We're a national firm, 15th biggest in the country. We've got some strong roots here in the Midwest, though. We've got offices in Wisconsin, in Appleton, Madison, Milwaukee, and in Janesville, which is where this crew is from. But we also have a lot of roots in Wautlet County. We had a couple offices here at one point, but ultimately kind of moved those into the Janesville office. But a lot of client base here, and we love the opportunity to get over here and speak in Wautlet County. Our firm specializes along industry lines, construction, manufacturing, healthcare, small business. We bring people into our firm and kind of get them going down those paths to help our clients, we think, more effectively by staying in tune with their type of business. So I want to introduce the crew up here. To my immediate left is Brad McGuire. He's a partner in our Advantage kind of small business team. Tom Cagle is a senior manager on manufacturing. Scott Fisher, senior manager in manufacturing, and Kyle Mayer, senior manager in our Advantage small business team. So without further ado, we'll get going. Kyle's up first. I think he's going to talk about tax rates and individual tax.
Thanks, Pete. Good morning, everyone. Just not talk about tax rates right away, as soon as I figure out the clicker.
Yeah.
There we go. All right. So I wanted to start a little bit with the process of tax reform and how we got to where we sit today. So what is the process for tax reform? How did the folks in Washington, D.C. Move the new tax law forward? So it really started pre the 2016 presidential election in November, and then quickly accelerated from that point once the Republicans gained control in D.C. So really started out with 2 separate divisions, really the House, and within the House, the Ways and Means Committee, and then within the Senate Finance Committee. Both of those smaller committees came up with draft proposals to move that forward within the respective House and Senate. Once those were ironed out and approved by those groups, the conference committee came together and drafted the final proposal to present to the president. So timing the conference committee, that happened early December, and within a couple weeks, President Trump had signed it into law. So the tax reform prior to 2018 and the changes we're talking about today was written in 1986. And this tax reform is really a rewrite or an amendment to the 1986 tax code. It's not totally starting from scratch. It's revisions or changes to that base 1986 tax law. The individual changes, many of them will expire after 2025, but the corporate changes are permanent as tax law can be, and really until the elected officials in Washington do something different. So. For the tax rates and the individual income tax impact, there was a lot of discussion around simplification, and I think you'll see as we move forward, for W-2 employees, things were really simplified. The 1040 is going to look a little bit different. Those forms haven't been released, but From an individual standpoint and a non-business owner, W-2 employee, things are going to really look a lot simpler and be easier fast forward 12 months once you file your 2018 tax return. So the corporate rates, there was a permanent rate reduction from 35% down to 21%. These rates don't factor in the Wisconsin impact, so Wisconsin taxes are deductible for C corporations, so these rates are effectively slightly lower than that. The 21% is a flat rate, so it's effective on your first dollar of income as well as your millionth dollar of income. It's 21% across the board. Under the old tax law, there was a 15% bracket for the first $50,000 of C corp profits. So smaller C corporations will see a small impact or increase in their tax returns or taxes as a result of the 21% flat rate. So what do the individual brackets look like? The chart here lists, the top line is 2017 and what the rates were as you move across taxable income as shown on the bottom. So 2017 versus 2018. The original proposals that were floating around the House and Senate, many of them contained 3 different tax brackets. Obviously they settled on the existing 7 or 7, such as the existing tax law had prior to that. So essentially there's across the board rate reductions, but likely I think taxpayers are going to move through the brackets a little bit quicker based on some of the other changes that were taking place. And the top rate previously was 39.6%, now it's 37%. For single tax filers, many of these rates take place at exactly 50% of what the married filing joint return will be. So, 24% where that bracket starts is exactly 1/2 of where it starts from a married filing joint standpoint. Capital gains rates really didn't change. The capital gain tax rate you pay is driven based on your other income and what tax bracket your other ordinary income falls into. So either 0, 15, or 20%. And the 3.8% net investment income tax will continue to exist for those taxpayers with adjusted gross income over $250,000. Estate and trust rates, virtually no changes outside of kind of trying to mirror the individual rates. Again, capping the top rate at 37% versus the 39.6%. So what are some of the specific changes that will affect tax law going forward and individual tax returns? The recharacterization of Roth conversions have been repealed. So back in 2009-10, when the stock market had suppressed, they came out with a way to convert a traditional IRA to a Roth IRA. You would pay the tax immediately, and then obviously going forward, if the IRA balance grows, you're in a much better position because you can take those IRA balances tax-free at that point. Well, there's some areas of the market that have declined further, and so this recharacterization allows you to undo those Roth conversions, essentially put them back into a traditional IRA. You're no longer able to do that, but with the markets rebounding the way they have over the last couple of years, this isn't something we're seeing a whole lot of lately. Alimony is no longer taxable or deductible if the divorce decrees are signed and agreed to after December 31st of 2018. So this is one area where it's not impacting tax law effective January 1st for all of the 2018 tax year. It's actually a year out. The reason for that being is obviously the attorneys, we got to tax reform being signed pretty quickly and the attorneys were working on a lot of cases, and if on December 22nd when that was signed into law 10 days later, they're having this drastic change in what the taxability of alimony is, you can imagine what that would do to those divorce cases and how things would move forward. So there is no change in child support. That will continue to be non-taxable. The child tax credit, there's some nice increases here where I think a lot more taxpayers will be able to benefit from this credit. They've increased the adjusted gross income threshold to $400,000, and they've also doubled the credit to $2,000. Standard deduction changes. The standard deduction for a single return was roughly doubled to $12,000, and for married filing joint doubled to $24,000. This is where I think you'll see a lot of simplification moving forward for 2018 and beyond. With these increased standard deductions, there will be a lot more taxpayers that fall into this bucket than have in years past. Personal exemptions have been repealed. That's $4,000 for each person, taxpayer, spouse, and any dependent children. So the thought there is that's going away because the standard deduction has been increased. So the miscellaneous itemized deductions have been removed. As far as unreimbursed employee business expenses, those would have been claimed on Form 2106 in past years, and the investment advisory fees are no longer deductible if they exceed 2% of your adjusted gross income. State and local taxes and mortgage interest, these are two of the most significant changes in the itemized deduction arena. So the state and local taxes are capped now at $10,000. And that includes state income taxes as well as property taxes. So in Wisconsin, we have a pretty high state income tax rate comparatively speaking to other states, and obviously property taxes pretty quickly exceed $10,000 on an annual basis for taxpayers. So most people will be over that $10,000 threshold that they're going to be capped at going forward. Mortgage interest, they've limited the former $1 million limit on mortgage acquisition debt to $750,000. So once you exceed that, the interest on that debt is not fully deductible as an itemized deduction. And then the other piece of this is the home equity lines of credit. If the proceeds from the home equity line of credit are not used to improve the residence, which is secured or secures the home equity line of credit, that is no longer deductible as well going forward. The 3.8% net investment income tax that I had mentioned before that applies on adjusted gross income over $250,000 on investment income, if your adjusted gross income is over $250,000, was essentially not touched. It wasn't really part of tax reform. They were deferring to the healthcare task force and looking at what the Affordable Care Act would look like and letting that group decide how the Affordable Care Act would be handled. So the individual health insurance mandate is waived after 2018. So for 2019, that is not applicable. There's a lot of questions around reporting and the 1095s and reporting of insurance coverage as to whether or not that's really going to happen next January, February, when we're essentially in this 12-month period where that mandate is going away. 529 plans, there's been an expansion of qualified expenses under that, so you can take a distribution from 529 plans to qualify for elementary and high school expenses. The alternative minimum tax is a flat tax that many high-income taxpayers were subject to in the past. There's been small changes here, but the likelihood of being subject to AMT going forward is going to be drastically reduced because of the cap on many of the itemized deductions. So for instance, Wisconsin, the state income tax deduction as well as the real estate taxes were an add back for alternative minimum tax. So for many of our clients, that was what caused them, solely that factor caused them to pay alternative minimum tax. And with the cap at $10,000, it's likely that fewer and fewer taxpayers will be subject to alternative minimum tax. NOL carrybacks are non-existent except for farmers. Before you were able to carry back losses 2 years to get immediate tax refunds. Now those are just carried forward indefinitely. The estate tax, the lifetime exemption was doubled to $11 million a person, $22 million for a married couple, and the rate remains unchanged. So the estate tax is going to have implications or fewer implications because of the increased limit, and it's an opportunity for individuals to do planning that were in the past potentially subject to estate tax if their estate was over the $5 million hurdle. Now they've got another $5 million to plan accordingly in their estate plans. So planning opportunities, what are some takeaways today? The first thing is talk to your tax advisor. There's a lot of new changes and a lot of different things that we can help with or your advisors can help with moving forward. The first one I have listed here is charitable contributions. So if you itemize, there's a couple different things you can do. Either make your charitable contributions directly from an IRA, so that would exclude that income from being taxable, but you also would get the charitable contribution. So because the higher standard deduction, fewer clients are going to be itemizing, but if you're able to take an RMD from your IRA and convert that directly to a charitable organization, it's going to reduce your overall taxable income. The second one is double up contributions every other year. So, if you give $5,000 a year to charity, do 10 in 1 year and 0 the next to try and exceed the standard deduction threshold. Easy to say, but difficult to do, obviously, when the charities need help from all of us. So, set up a donor advised fund or donate appreciated stock, which can avoid capital gains. So if you donate the appreciated stock, you don't have to pay tax on the capital gains. Real estate taxes in Wisconsin, many of you probably know, are due January and July. A lot of people have often prepaid those in December to get the tax deduction. The benefit of that is likely very limited going forward. So you can defer paying them until they're actually due. There weren't really any changes around the IRA or retirement plan limits, so make sure you're taking advantage of those opportunities to limit taxable income and reduce taxes, as well as the HSA contributions. If you're covered by a high deductible health plan, you could consider making HSA contributions. The last item is to check your withholding and quarterly estimated tax payments. So many employers adjusted the wage withholding rates back in February and March. You probably all noticed changes in your paycheck earlier on this year, but because of that, just making sure your withholding seems on par with what you would expect. So that's all I have. I'll turn it over to Tom to talk about the depreciation changes.
Thank you. Depreciation is an area, we're getting into the business area now. Depreciation is an area that's become so favorable that a lot of businesses can just write off everything they add as far as business property. There are two sections, section 179 expense it's called, and then there's bonus depreciation. Before I get into those, I want to talk about real estate, because there are some real estate changes that affect both 179 and bonus. There was discussion about changing real estate depreciation lives to 25 years across the board. That was in the Senate version. It didn't pass, and we're still stuck with the same old rules where it's 27.5-year depreciation lives for residential property and 39 for non-residential. Before this year, there were also three categories on the bottom: qualified leasehold improvement, qualified restaurant, and qualified retail improvement. If you fit into those categories, you could get a favorable depreciation of life. Those have been repealed and replaced by a new category in the middle called qualified improvement property. We're trying to simplify it and just have one category. If you fit into that category, you can escape the 39-year life and write things off a lot quicker. So qualified improvement property is improvements to an interior part of the building, but it has to be for non-residential properties. It's not going to affect rental properties. It's non-residential real property, and it has to be made after the date that the building was first placed in service. Because it's interior, it does not include enlargements of the building. You can't expand and increase the footprint. It can't be structural. So it's basically an interior remodeling or build-out. You could have a project that includes both qualified improvement property as well as an expansion. You want to segregate the part that qualifies as being interior, which would qualify in this category, versus the part that's in addition to the building that would not qualify for this category. Now let's get into bonus and 179 in particular. I'll tie into the qualified improvement property into these as I go along. Bonus depreciation is basically an ability to write off an amount of the assets you add. It's usually for tangible personal property. This had been 50%. It came into the code in 2001 after the September 11th attacks. It was 30%, went to 50, spiked up to 100 for 1 year, back down to 50. Now they've changed it back to 100% for assets acquired and placed in service after September 27th. That's an odd date, but that's the date that the current administration came out with a white paper in which they floated a lot of various tax ideas that they thought should be in tax reform. So they picked that date as the cutoff for the new 100% bonus. Keep in mind you have to both acquire it and place in service after that date. If you had a binding contract to acquire an asset before that date, you are still under the old 50% rule. This is only good for 5 years to 100%. It's going to go through 2022, and then it phases back down 80, 60, 40, 20. And then by 2027, it's down to 0. So bonus depreciation is set to phase out. I think they'll probably change it and reinstate it, but at the moment, it's not a permanent thing. And there's no amount to the bonus depreciation you can take. As we'll see with 179 expense, there are limitations. So here's what this looks like. Most people are going to be basically in this category right here. This is where we are for assets from 2018 to 2022, 100%, and then it's going to start to phase down. What qualifies for bonus? It's property with a depreciation life of 20 years or less, which is most tangible property that you buy. I mentioned this qualified improvement property concept. The idea was that qualified improvement property, this real estate concept, would qualify for both 179 expense and bonus depreciation. However, they forgot to assign it a 15-year life in the tax code. They made a drafting error by omitting something that should have been in there. So because they failed to define it as 15-year property, at the moment, QIP is 39-year property and it doesn't qualify for bonus. So this is a gaffe in the drafting that they have to correct. Until they correct it, QIP would not be eligible for bonus. Another important thing with bonus that now applies to used property. The old bonus rules, it only applied to new property. So the fact that it applies to used property is very helpful. If you buy used things or trade things in, or if you buy another business altogether, you can get bonus on that. Section 179 is the other one. There's a good deal of overlap between bonus and 179. The amount of 179 expense you can take is up to $1 million a year beginning in tax years after 2017. It was $500,000 before. And this $1 million limit sounds very generous, but it does phase out. If you have more than $2.5 million of qualifying additions, the $1 million is decreased as you get over the 2.5. So I have 2.6 million of qualifying additions. I'm 100,000 over the 2.5. That means my $1 million limit goes down by 100,000 to 900,000. So if you have $3.5 million of additions, you get no 179. Large corporations do not get this. There's also a special rule that cannot create a business loss with 179. So you can't just take an unlimited amount and create losses. If you create a loss, overall taxable loss in the business, you have to carry that expense over to the next year, which could be okay because you can take it immediately next year, potentially. All right, so 179 assets, again, there's an overlap with bonus. It's basically tangible personal property and off-the-shelf software. That's been around forever. The new law allows qualified improvement property also, as I mentioned. The definitional problem with 15 years, which prevents it from being eligible for bonus because they failed to do that, that doesn't affect 179 expense. So right now, qualified improvement property qualifies as 179 expense, but not for bonus at the moment. There's also some additional things that they added this year. Again, this is for non-residential real property, roofs, HVAC, fire protection, alarms, and security systems. So that's a helpful thing because in the past, people put on roofs, they were not sure if it was a repair, whether they had to capitalize it and depreciate over a long period of time. Now they just give it to you. And then the final thing that they added was in hotels and apartments and rental properties where people live, you can now deduct personal property used in those things. So beds, appliances, furniture, and apartments and rentals can now be deducted under 179. In the past, they could not. So here's a chart that summarizes the difference since there is significant overlap. They're not the same, as I mentioned. Bonus is set to phase out. I think it'll probably be extended at some point. $179 million limitation. It's a permanent item, though it's not going to sunset on a certain date. One thing about 179 expense, you can pick and choose whether to take 100% write-off on each individual asset. You can pick and choose asset by asset what you want to do. If you don't take 179 expense on an asset, then if that asset qualifies for bonus, you have to take bonus. So bonus is mandatory if it applies, unless you elect out, because you can't elect out asset by asset. You have to elect out by asset class. So you could say, I'm not going to take bonus on all 5-year assets. I'm not going to take bonus on all 7-year assets. So it's kind of a general thing. It's not an asset by asset as 179 is. So that's a key difference between these two. I mentioned the roofs and the HVAC and so forth. That's good for 179, but not for bonus. On the other hand, land improvements such as parking lots, sidewalks, fences, qualifiers for bonus but not 179. So using these two categories, you can pretty much find a category, one of those two, where you're going to be able to take this deduction. There's also a limitation for SUVs, only $25,000 of 179. And I mentioned the business limitation, the income limitation for 179 expense. You can take as much bonus depreciation as you want, create huge losses, there's no problem with that. 179 expense, you cannot go negative on your business income. So if you create a loss in your business, that excess loss has to be carried over into the next year. And you have to do this not only at the entity level, but as the shareholder or partner level. So here, the S corporate partnership applies at that level, but also at the level of each individual partner or shareholder. So it's a double analysis. Autos are more favorable than before. And the old law, you could only deduct $3,000, even if you had a $50,000 car, you only deduct $3,000 the first year, $5,000 the second year, and so forth. They bumped those numbers up to those numbers you see on the right, 10,000, 16, and so forth. You also can take bonus depreciation on autos. Under the old rule, you could take 8,000 of additional bonus. So in the old law, you had 3,160 plus 8,000 if it was new. Under the new law, 10,000 plus bonus, but the $8,000 bonus is being phased down, so it's only $6,400 this year. It's going to be $1,600 less the next year, and so forth. The only good thing about the bonus for autos is that because bonus now applies to used assets, you can buy a used car and take the bonus on it. You pass it or not. This assumes also that the personal use of the auto is in the income of the person who drives the car. You're supposed to, when you have a business auto, typically people usually part for business and part for personal use. The personal use value is supposed to be in the W-2 of the person using the vehicle. These depreciation limits assume that you're complying with the auto valuation and the income of the person who's driving the car. A very important thing for real estate is what's called cost segregation studies. When you do a real estate project, whether it's remodeling or actual construction of a new building, you would think that most of the building is just going to be 39-year real estate. But there are components in the building that actually are depreciable over a much shorter period of time. This is pretty technical stuff. We have people who do this, and you walk into the guy's office, and he's got literally blueprints in his office that he's looking at to understand what went into the construction of the building. Because in any building, you can probably find, I would guess, 10 to 15% of the cost actually is reclassifiable as personal property. And if you do that, you can get a 100% write-off. So if you have $1 million project and you identify $100,000 as personal property, that qualifies as 179 bonus, you get a $100,000 write-off for that portion rather than taking it over potentially 39 years. This is a huge thing. Anytime you do a real estate project, you have to make this analysis, otherwise you're leaving money on the table. Okay. So, planning opportunities in this area. I just mentioned the cross segregation studies. This also applies if you buy a building. If you build a building, yes, you can do that. But if you buy a building from someone else, you're also allowed to look at the components. You have to find someone who's qualified to do this. It's not a very easy thing to do. Another thing regarding depreciation in general, if you have a year where you add a lot of equipment, you have the opportunity to engineer your taxable income. You could take a little depreciation, a lot of depreciation, or something in between. Your taxable income could be engineered up or down depending on how much depreciation Okay. You could find yourself in a high tax bracket or a lower tax bracket, depending on what you decide to do. So you have a choice as what your tax limitation should be. You may take a lot of depreciation. That may put you.
All right, I'm going to go over some of the changes in the business income taxes that passed through with the new tax law. To start off, like-kind exchanges. And previously, like-kind exchanges could be used for real property or personal property. They did away with the like-kind exchanges for personal property. Where we see this a lot is people trade in vehicles all the time. So if you saw Tom's slide before, depreciation on vehicles is usually pretty limited. So if somebody's traded in a vehicle year after year after year, a lot of the times they've built up a huge cost basis on that asset because the value of the vehicle goes down, but the cost basis doesn't as much because depreciation is limited. So we're going to see a lot of clients with assets that they're going to get rid of. They're not going to be able to defer the gain on that, but most of them are going to be losses on those vehicles. Where I see this a lot too is being in the manufacturing group is sometimes our clients might take a piece of machinery that may be worth a couple $100,000. They might write that off in the first year, and then when they go to trade that in, they used to be able to defer that gain on that new piece of property that they bought. Going forward, they're going to have to recognize that gain the year in which they traded in based on the fair market value of that property. So that's where we're going to see that the most. Like-kind exchanges on real property are still going to be a powerful tool. If you have a piece of property that is appreciated in value, you're looking at maybe getting rid of it and going into a different piece of property. If you still use the qualified intermediary and use that as a way to defer a gain, it's still a very powerful tool going forward, so I did retain that. There are some new simplified methods of accounting. I think $25 million is going to be something you're going to see a lot here. For small businesses, they did provide some additional ways to make accounting simplified for smaller businesses that have less than $25 million of annual average gross receipts. And one of those methods is going to be they can use the cash method of accounting. Previously, if you were a C corporation or you were a partnership that had a C corporation partner, you could not use the cash method of accounting unless you were under $10 million of annual gross receipts. Now they bumped that up to $25 million, so a lot more businesses are going to qualify for the cash method of accounting. So that's something that you might want to look at for your business or for other clients. Some other methods that were simplified for small businesses, again, this $25 million threshold applies to these as well. Unicap requirements. So if you have inventory, you would have to calculate 263A, they called it, or Unicap for short. You can't just add the cost of your inventory. You have to take some of your admin expenses, run a calculation, add that to your inventory, which would increase your income. If you are under $25 million, you can potentially not have to do an Unicap anymore. So that's a good way to save a little bit of compliance work for some of our smaller clients. If you meet certain requirements on your inventory, you might not even have to use inventory anymore if you meet some other requirements and are under that $25 million threshold. And also percentage of completion for long-term contracts was required if you were over $10 million of gross receipts in the past. Now it's $25 million. So some of our clients that were being required to use the percentage of completion can now use like a completed contract, which is a lot simpler for them. And again, anytime you change accounting methods for the IRS, there's two different types of accounting method changes. You either have to ask for permission, which is a non-automatic change, and that comes with a relatively high user fee. We are expecting that many of these changes will be under the automatic kind, meaning you don't have to ask permission. It's an automatic change. You have to fill out this Form 3115. It gets attached to your tax return. If it's a deduction, you can take the deduction entirely in the 1 year in which you're making the change. So you just figure out what your taxable income was under your old method, what it was under the new method. If it's a deduction, you can take that deduction on your current tax return. If it goes the other way, let's say you're picking up more income after you change your accounting method, you can elect to pick up that income over a 4-year spread. So most of the time, you're going to change accounting methods to get the deduction, so it could be a potential deduction all in the 1 year. So this has been talked about a lot, this business interest expense limitation. It's only going to apply again for businesses that have average gross receipts under over $25 million. So if you're under $25 million as a business, you're not going to have to worry about this. But once you creep over that, there's going to be a business interest limitation. And what you need to do is, and it's a very complex computation. As Kyle said, this didn't get simpler. I think Pete might have said it. This didn't get simpler, this tax law. It made a lot more complications. And this is one of them. So basically, if you take your taxable income, if you're over the $25 million mark, you're going to have to take your taxable income, look at your interest expense, your business interest expense, and it's going to be limited to 30% of that number. All right, so if you're a partnership, you're going to have to figure out and pass that through to each of your partners. And what's going to happen is on the partnership tax return, it's going to get limited there. So the K-1s are only going to pass out the allowable interest, and it's going to withhold that carryover, that interest that is disallowed. It's going to withhold that, carry it over to next year, and if next year you don't meet that 30%, then it will add that to the current interest and allow that deduction in the next year. So there'll be some kind of carryover provisions going forward. Again, this is just talking about, it's going to be held at the partnership level, and then each of the partners will pick up their allowable business interest expense on their K-1s. Just defining what business interest is. This doesn't apply to investment interest, so if a partnership has investment interest and business interest, usually you split those out on the K-1s. It wouldn't apply to the investment interest. So if you are a real property or a farming trade, you might be a little more highly leveraged than some of these other manufacturers or restaurants, that kind of stuff. So they added this special rule where you can elect out of this 30% business interest limitation. The problem is if you elect out of that, you are stuck with it. It is an irrevocable election. And on Tom's slides, he talked about this 100% bonus depreciation. Once you elect out of it, you are no longer allowed to use 100% bonus. Going forward, that's it, you're done. And then, not only that, but the assets that you elect, or once you elect to opt out of this 30% business interest limitation, then the assets not only are not allowed 100% bonus, but they're not allowed accelerated depreciation either. So you have to use a straight line ADS method. So a straight line, and it's longer tax life. So you're basically giving up you're basically allowing more interest expense deduction, but you're taking a hit on the depreciation and kind of your control over the depreciation, which the bonus allows. What does real property, trade, or business mean? You can read it here, development, redevelopment, construction, operation, management, leasing, brokerage, rentals, fall under those categories. We still haven't seen how these elections are going to work. We're assuming the IRS is going to provide us some guidance here in the next few months, but probably not till January, or most likely. A lot of questions we've been getting from clients on the meals and entertainment. You've probably heard a lot about this. In the past, meals and entertainment were 50% deductible by businesses. So going forward, there will be no deduction allowed for entertainment expenses. So what we've been telling our clients, because they've been being approached by their payroll services and by their general ledger services, is how do we quantify this? Because it's going to get a little bit complicated, because When is something an entertainment and when is it a meal, and are you discussing business during all of those? It used to be you just kind of threw it all in a bucket and said, okay, well, it's going to be 50% deductible. Now we're telling our clients, you're going to probably want to set up new general ledger accounts and track what is entertainment expenses and what is food and beverage that are meals and entertainment that are meals, not entertainment, just meals that are going to be 50% deductible. So things like greens fees, so when Pete takes us out and we play the Palmer later, and he's not going to be able to deduct that at all, even if we're talking business, but when he buys us lunch at the Turn, that would be 50% deductible for Pete, so thanks, Pete. And I did put a little link on the bottom here. If you are interested, today at noon, Baker Tilly is putting on a webinar. So if you go to that link, you can sign up. There's a webinar that will go into this meals and entertainment information a little more in depth. So you're all invited to do that if you want. It's an hour long, so if it's over your lunch period, which you won't be able to deduct, probably. All right, moving expenses. What's that? Yeah, there you go, 50% because it's business. Thanks, Brad. So moving expenses have been eliminated. You won't be able to deduct those on your tax return going forward, and your employer will not be able to reimburse you non-taxable wise for that. So if you do get moving expenses reimbursed to you by your employer, it will be added to your W-2. In the past, those were potentially not added to your W-2 and still deductible by the employer. So it's just trying to marry up the fact that they got rid of it for income tax purposes on your individual tax return. They're not going to allow you to get the tax-free benefit as well. Doesn't apply to many people around here, but if you have transit passes, or I know our Baker Tilly people, I think in Milwaukee, get parking reimbursed, that will no longer be allowed as a taxable fringe benefit. It will be a taxable fringe benefit going forward. It used to be removed from the W-2. Employee Achievement Awards, basically this is saying if you're an employee, you get an achievement award for 5, 10, 12, 15, whatever year it is. You used to be able to exclude some of these items from your income, and the employer used to be able to deduct them. Now if they are basically cash, gift cards, anything that has some fair market value that is readily determinable, it's going to have to be added to your W-2 for the employer to deduct it. Tuition reimbursement. The tuition reimbursement remains. What this is up here for is just kind of to remind you that you should, if you do have a tuition reimbursement plan, or your employer does, they should make sure that it does meet the Section 127 requirements, because that is going to be, you used to be able to fall under 2 different code sections to have it qualify, but this has been reduced down to the Section 127, and the ones that fell under the other code section are no longer going to be allowed, so they just need to be looked at for revision to make sure that they do qualify, because employers can reimburse non-taxable up to $5,250 per employee. And this becomes a big deal too, because if you incur business expenses for your education, those used to be deductible on Schedule A for the miscellaneous 2% deduction. But as Kyle noted, that those have gone away, so that's not going to be allowed as a deduction by the employee anymore. Domestic production activities deduction. So this was a big deal for our manufacturers and some of our construction clients. It was a 9% deduction based on taxable income of the manufacturer. That has been repealed and is no longer allowed going forward. 2017 was the last year for that. New business credits, this family and medical leave credit is something I think a lot of taxpayers will be able to take advantage of. I think a lot of our clients, and I'm sure a lot of businesses in here, do provide this. So there is a new credit going forward that they should probably look at and make sure that they're quantifying how much they're paying in family and medical leave, because there will be a credit going forward. And it just talks about what the credit is and how to compute it. 3 credits that were on the chopping block and then made it into the final tax bill were the new markets tax credits, the employer provided child care credit, and then the work opportunity tax credit, which is a credit if you hire a veteran, maybe a felon, I think falls into that category. If you hire a certain targeted group, person, employee, you can get a credit. You got to get it certified by the state and put it on your tax return. But it can be worth it if you have enough of those employees that do fall into that targeted group category. R&D expenses, again, another big thing for our manufacturers. They have a lot of R&D expenses. They get a decent sized credit, which is still in the tax law. The R&D expenses were usually 100% deductible in the current year. Going forward, starting after 2021, these expenses are going to have to be basically capitalized and written off over a 5-year period. Excess business losses. So this is going to affect the individuals that get pass-through income. And Tom talked about it earlier with his bonus depreciation, where he talked about the fact that you could take bonus and maybe create a net operating loss on your corporation or your partnership, pass that through to the individuals, and they'd be able to take that loss on their tax return. If it drove them into a loss and on their personal tax return, they could carry that back, potentially get some refund back. Well, this is going to kind of put the stop to that. Okay, so they have started with this. 2018, they're going to limit any business losses to $500,000 on a joint return, $250,000 if you're single. So what that means is if you have $250,000 in wages and you have a $500,000 loss, okay, well, you're going to go to an NOL situation, but you're not going to be able to carry it back. Like Kyle said, it's going to have to go forward now, all right? And there's going to, again, it didn't get simpler. There's going to have to be another form that's going to have to calculate what this business loss is, how much is going to be carried forward. So you're not, the planning at the business level that's going to get passed through to the individuals is going to have to be a little more complex, because driving huge NOLs or making taxable income from these partnerships or S corporations is probably not going to be as valuable anymore, because you're going to get limited on your individual tax return and you're not going to be able to carry it back. So there's a lot of limitations that go along with this additional bonus that they're going to be allowing. And again, it's applied at the partner or S corporation shareholder level, and this is after the passive loss rules are applied. So if you're a passive shareholder or a partner in a partnership or S corporation, it's going to get hung up first at that passive loss limitation first before it gets to this business limitation of $500,000. For C corporations, again, they did away with NOLs for C corps as well. It used to be a carryback of 2 years and then a potential carry forward of 20 years. So 2017 is the last year, as of right now, that you're going to be able to carry back losses to previous years for at both the individual level and at the C corporation level. But the carry forward for C corporations and for individuals is unlimited now. It used to be limited to 5 or 20 years, but it's unlimited now. Again, this talks about the NOLs that are carrying forward. You can only offset, again, 80% of your current year income. So now not only can you not carry it back, you can't even wipe out next year's income. It's going to get limited as well to 80% of the current year taxable income. And this is a little more in depth, but I just wanted to point out the fact that if you heard about this while this tax law was being built up, and he talked about all these foreign investments or all these foreign corporations that the U.S. corporations had and all these profits that were being held overseas. So what they did was they said, okay, well, if you have any of these foreign corporations that are currently not being taxed in the United States, we are going to figure out how much of that accumulated earnings is over there, and we're going to make those corporations pay tax on that. So that's how they're getting many of these large corporations to pay tax on these foreign earnings. What happens though is it trickles down and it applies to anybody that owns a foreign corporation. And I have 3, 4, 5 clients that they're not large, but they're, foreign corporations in Costa Rica or, in some of these tax havens down in the Caribbean. So if you do have any of those, again, these are due with your 2017 tax return. So if you haven't filed your tax return yet, and you do have it's a Form 5471. If you have it, you probably know you have it. If you don't, you've never heard of it, you don't have it. So just so you know that there is some additional tax that can be paid out over an 8-year spread if you do have something like that. So tax planning opportunities. Simplified accounting rules, again, if you're under $25 million, but we're over that $10 million previous threshold, you might want to look at looking at new accounting rules that will simplify your accounting. Interest expense limitation, again, you're going to want to look at that, see if that'll impact you. Meals and entertainment classification. We have our clients setting up new accounts now. They're doing the allocation as they go throughout the year instead of getting to the end of the year and trying to figure out what is 100% non-deductible and what is 50% deductible. Family and medical leave credit, that's a new one that everyone's going to want to look and see and quantify how much they're paying in. And then like I talked about, this net operating loss planning and how you want to, if you have a pass-through entity, how much depreciation you want to take and how much you want to pass through to your shareholders or partners. So. And with that, I will turn it over to Pete.
This relates to qualified business income deduction, or this 20% deduction on pass-through entities. And how's that going to affect me? Because we've got a lot of partnerships, S-corps, and this does apply to sole proprietorships and rental property as well, potentially. Let's see. Okay, so what is the deduction for qualified business income? So years beginning after 17, which would be starting in 18, and through 2025, there's this new category of income called qualified business income. And an individual taxpayer can deduct 20% of that income on their return. So the pass-through entity is going to flow through income to you. You get to calculate this 20% deduction and take it on your return. And in its simplest form, that's what it is. But there's complexities to it. So what is that type of income? It's ordinary non-investment income of a business, just as you generally define it. Your income minus your applicable expenses. You'll often hear that income will have not a 37% rate, but a 29.6% rate. What they're trying to get at is to say, hey, before I had $100,000 of income flowing through to my return, I'm in the highest tax bracket at 37%, but now I've only got $80,000 at 37%, or effectively 29.6% on that $100,000. The income must be from a trade or business. I'm going to get more into that on the next slide here. And this last sentence has a couple things in it that are important. QBI, qualified business income, is evaluated on a business-by-business basis. So if I've got 3 S-corps flowing through to me, I have to do these calculations we're going to talk about on each one individually. I can't sum everything up and then make one calculation. In addition to that, this deduction does not offset self-employment tax or the net investment income tax, only the ordinary income tax. Again, the provision is not permanent. It ends in 2025. So the deduction is taken on the individual return or on a tax-paying trust. So again, the income is flowing through to you on your individual return, and that's where the deduction is being calculated. What are the sources of QBI? I mentioned partnerships and S-corps, sole proprietorships, your Schedule C. Also, rental income characterized as a trade or business. And What we mean by that is, as the law is right now, that rental income has to, again, qualify as a trade or business as opposed to being just an investment. So if I've got multiple rental properties and I'm in that business on a daily basis, with those properties, that could qualify as a trade or business. But a common situation for our clients is they've got an operating S corp and maybe they've got real estate in an LLC, and all that's happening is the operating entity is paying rent to this LLC. It's a triple net lease. All I'm doing is collecting one rent check and paying my mortgage. As it stands right now, that would be investment property. That's not that. Looking at that singularly, it's not a trade or business. We expect some clarity on this, to be quite honest. Going forward, the Treasury could clarify this and potentially make that a trade or business or kind of combined with the operating entity. But as the law stands right now, that would not qualify for this deduction. And C corps do not qualify as well. So again, at its highest level, it's 20% of that qualified business income. And now we get into kind of the nuances and the calculations that need to be done. So the first one is there's a certain taxable income threshold at the individual level that if you're below that, you simply get the 20%. So if I'm married filing joint and my taxable income is below $315,000 and I had that $100,000 flow through to me, I do get the 20% deduction. In the next slides, we'll kind of talk about what happens if my income's over 315. But under 315, I get the deduction. The only limitation to that is these next 2 points. With my S corp, let's say, I need to take reasonable compensation. So maybe my S corp, before I take compensation, I've got $200,000 of income, and I'm going to take 100 in compensation, and 100 flows through to me. Well, the 100 in compensation, I don't get the deduction for that. I only get the deduction for the 100 that's left, that's net flowing through to me. But you might say then, well, why don't I take no compensation, let the 200 flow through to me, and I'll get the 20% on the 200. That gets back to reasonable compensation. The IRS says you need to take reasonable compensation. You can't just let the 200 flow through to you. You have to take reasonable compensation first. So again, and that's similar to in the past. Okay, so now we get to the point of that 315. It was the first threshold amount. If we get above 315,000 for married filing joint, we start to get into a phase-out range. So between 315 on married filing joint and 415 on married filing joint, there's kind of a phase-out range. And above 415,000 of taxable income, all of a sudden some other rules kick in. The biggest one being that there's 10 service trades or businesses singled out that will not qualify for the deduction. Those are health, law, accounting. You can read them. They're basically service-based businesses. And there's also a catch-all that kind of says where your principal asset is your reputation or skill, that would not qualify. So if I'm the attorney and I've got 300,000 of taxable income, I'm in one of those categories, but my taxable income is below 315, I get the deduction. But if I'm at 500,000 of taxable income and I'm an attorney, I'm in one of those categories, the deduction just goes away. So there's some calculations to be done there. I've got a couple slides further on that kind of lay this out a little bit. But again, the threshold is at 157 for individual and 315 for married filing joint, and then there's this phase-out range. And I mentioned the 415,000. So the phase-out range for married filing joint is between 315 and 415. In that range, you kind of get a partial deduction if you fall into one of those service categories. So now, if I'm above 415,000, if I'm in one of those services, I'm out. I can't take the deduction. If I'm anybody else, if I just generally qualify for the deduction, now I've got a couple other hoops I have to jump through. So the 20% deduction is limited to the lesser of the 20% of QBI or the greater of 50% of my W-2 wages from that entity, or 25% of my W-2 wages plus 2.5% of my unadjusted basis of depreciable property. So again, a little bit of calculation here. Unadjusted basis and depreciable property would be my original cost. So tried to put a little example here, not to get too hung up in the calculations, but just let's just assume wages of $50,000 and property of $400,000 original cost. Let's say my QBI is $100,000 times 20%, that's $20,000. So I'm going to compare that to the greater of the next two items, which the first limitation is I've got wages of $50,000 times 50% is $25,000. And then the second limitation, I can do the calculation there. And so I'm taking the, first the greater of the bottom two, 25,000 or 22,500. So I'm taking 25,000, comparing it to 20,000, and taking the lesser of those two. So a lot of math there. Don't want to get too hung up in it, but we'll see on the next slides that you'll often hear people talk about wages and this 20% deduction and how that affects it. And there are planning opportunities around that because we want to maximize this deduction if we can. So this slide, again, just kind of lays it out in relatively simple terms, I guess. Am I above 315? No, then I get the 20%. Yes, I'm above the 315, then I have to decide whether I'm a service business, because if I am, I'm out. And if I'm not a service business, then I have to go through this other calculation. And again, there is a phase-out range in there, which I don't want to get hung up on, because then you're just kind of doing more math. But that's in general what's going on. So I tried to lay out a few examples here of how something might look. So in this case, I'm saying my taxable income at my individual level is below 315, so it's at $200,000. So if I'm a Schedule C sole proprietor, I've got $200,000 of income, and let's say that all came from my Schedule C. My QBI is 200, 20% of that is $40,000, my deduction is $40,000. So in the next two, the S-Corp and the partnership, I basically have the same facts, except that in the S-Corp, I'm taking $80,000 in wages because that's my reasonable comp. So I've got, instead of $200,000 of income, I've taken 80 in wages, so my QBI is 120, 20% of that is $24,000, so my deduction is $24,000. So just to look at that, in that simple case, you would say, well, I'd rather be a sole proprietor than an S-Corp because I lost out part of that deduction, potentially. And this is where I will again go back to, this is probably the one area of the code where we really believe there's some Treasury kind of clarification as to some of these calculations that is going to take place, because I think that was easy for them, to put it into the tax reform at some base level, but there is still some clarification to come. So then I did an example of above the 315. So now my taxable income is 500. Well, now if I'm a sole proprietor, again, just the way the law is right now, well, I'm above 415, or excuse me, yeah, above 415, above the phase out. I'm a sole proprietor. My deduction would seemingly be $100,000, except now I've got those hoops to jump through about wages. Well, I have no wages at the sole proprietor level. So my W-2 wages are zero. I'm going to be limited to zero in that case. Whereas the S-Corp would create a deduction because I do have wages. I've taken $125,000 in compensation. And so I'm able to, when it gets down to that 50% of wages limitation, it's at 62.5. I'm comparing that to the 75,000, which is 20% of my QBI. I'm limited to the lesser of those two, and I would get a deduction. Partnership, again, you go through the math there, we get down to zero as well, because in this case, I've taken guaranteed payments and not wages. And again, point of clarification, just as the law is written, there would be no wages, but again, we foresee that there may be something here that's kind of unintended consequences here. But again, that's kind of the math on it. And I point out the math because, when we talk about planning and looking ahead, if you go to that middle column and say, well, I took 125 in wages, what if I took a 150? Would my deduction be bigger? And it actually would if you kind of go through the math, because your wages are higher. And so we get into this kind of, hey, what wages should I take to maximize that 20% deduction? There's always a give and take, right? Because if we take more wages, then there's more payroll taxes, and that's kind of offsets some of the benefits. So there's planning involved here. It's all kind of interrelated. This slide was an attempt to just kind of show maybe that what the ultimate tax benefit might look like. And so I just kind of said, hey, let's sample construction company. And I chose, this could say manufacturing too. Part of the reason I chose construction was to show, and this is something Scott mentioned about the domestic production activity deduction going away. So in 17, that construction company would have this 9% DPAD deduction, the $22,005 up there. That went away in 18, but in 18 we get the qualified business income. And so, assuming they meet all the other qualifications with the wages and whatnot, you do the math there and it comes out to, there's a tax savings for that entity of $8,900 with seemingly the same fact pattern from 17 to 18. Again, without all the limitations on the math. And just, so we saved 22% over the prior year. And so kind of just took that out to a couple of different income levels to see what the impact might be. Again, the key here is going to be, how do we maximize that qualified business deduction, given our fact pattern and the amount of wages and the amount of depreciable property that we have. So one other point related to this deduction is there's an enhanced accuracy-related penalty. I think this kind of goes hand in hand with the fact that, in general, there's an accuracy-related penalty that's if you're taxable, if your tax is less than 10% of what it should be, then an accuracy-related penalty can be involved. And if you have this deduction on your return, that's reduced to 5%, because I don't think they're worried about people manipulating information to try to maximize that deduction, so it might be closely looked at. So planning opportunities, this kind of ties in with both things that Scott and Tom talked about. Review wages paid to owners and related party expenses to maximize QBI. Again, we've got the opportunity to maybe manage our income and the form of the income in order to maximize that deduction. Evaluate accelerated depreciation impacts on QBI. Again, this goes back to, do I elect bonus or not? Do I drive my income down to zero, or do I leave some income in there in order to maybe gain the deduction, depending on what tax bracket I'm in? And so timing of deductions might be important to maximize this 20% deduction as well. All that being said, I would say consider these impacts in advance of the end of the year. This isn't something that December 15th you're trying to run through some numbers and what should I do. This is more of a, maybe not right now today, certainly to think about it today, but maybe in the fall to contact your tax advisor and to start down that path of, hey, what are the rules? Have they been clarified? What should I be doing as I approach the end of the year? What situation am I in? So I would just say this is something that probably takes a little more planning than, again, that right at the end of the year kind of thing. Again, stay tuned for clarity updates, because this is an area, you saw some of those slides with the kind of the unintended consequences, I think. I think there's some clarity coming on this, so stay tuned. Yeah, that's it for me. Probably the next biggest question we get is, should I convert my pass-through entity to a C Corp? And so that's what Mr. McGuire is going to take.
Wautlet over in Janesville. It's kind of an internal joke. So a couple of takeaways. I know we've been talking for quite some time. This isn't a tax simplification act, and I think we've said that a couple of times. Make sure that you're demanding from your accountant tax planning. It's a new year, it's a new law. The answers you've gotten in the past are not the same as the answers you should be getting now. And that's one of the questions that we're going to pose right now is pass-through entities. And Pete said this is the second most. I think throughout the firm we've had a lot of clients who have said, hey, look, there's a 21% rate at the corporate level. Shouldn't I be a C Corp now? So how many of you have a partnership or an S Corp? Raise your hand. So That's what most businesses have historically been. I mean, accountants love S corporations, attorneys love partnerships because they get to be really creative in the writing of those documents, and for good reason. But pass-through entities are typically how we've structured everything historically because of the lower individual rates that you get, especially when you factor in the potential business sale at some point. So we have had questions where, it kind of looks like on the surface that it's a no-brainer that you would want to change. And let me get my directions correct here. And I got them. So, when you look on the surface, the top individual tax bracket is 37%, and the top corporate tax rate right now is 21%. So can't we save taxes by saying, let's have our profits no longer flow through to us individually. Let's tax them at that 21%, let it stop there. We'll take the difference, invest it in our business, and we can grow faster. And on the surface, that may seem logical. Under the old law, the rates were so different that by the time you factored in any potential sale, it was almost always better off to be a flow-through entity unless you needed the flexibility of being a C corporation raising capital where you become very, very large. So just kind of looking at this under prior law, when you factored in the fact that the C corporation made money and then you distributed that money to you as a dividend, the total rate was about 50%, a little over 50%. We actually did that analysis for some people who were looking at liquidating a C corporation, and they'd been in a C corporation since the 70s, and they had some land in there. And by the time you factored in state taxes and local taxes, it was almost 52% that they were going to pay in tax to get out of the business, which basically allowed them enough to pay off the debt, and they walked away with no money after 40 years in the business. Whereas on a pass-through, if you were active, that rate was somewhere around 39.6, which is the top individual tax rate. So in the prior law, you had a 10% differential there that was beneficial for you to be a flow-through entity rather than a C corporation. Under the new law, that gap is at worst, it's closed. At best, it provides some benefit to being a C corporation. So under the new law, a C corporation, again, if you take out all of the profits, you end up paying somewhere around 39.8%. Whereas on the individual, and you don't have the 199A deduction, the qualified business income deduction that Pete was talking about, then you're going to be at 37%. If you're active and you do have it, then that drops down to about 29%. And again, that's if you're taking out all of the profits out of your business and not leaving anything in. So, in short, if you're taking the profits out and not reinvesting them in the business, you're still better off as a flow-through entity in most cases, from a strictly a tax rate standpoint. Keep in mind too that this is a decision that we tell people don't take lightly. Because the one thing that's certain in tax is that taxes are going to change. Tax law is going to change. 5 years from now, this tax law that we're talking about today will drift. How will it drift? Nobody has any ideas, or nobody has any knowledge anyway. The one thing that I can tell you for certain is that rates won't be exactly the same, deductions won't be exactly the same 5 years from now that we're talking to you about right now. So when you're making a change, and this is a monumental change, this is changing who you are as a business, changing from a flow-through entity to a C corporation. So under the corporate structure, there is a new lower tax rate. That tax rate's a flat 21% for corporations, as opposed to the graduated rate for individuals that you get with the flow-through. With the corporation, you do have a double tax. You have a tax on the income. So if you have a corporation that makes $100,000, you're going to take my picture and you'll make my hair look great. So it's digital cameras. So if the corporation makes $100,000, it's going to pay 21% of that, so it'll have $79,000 left. If you take that $79,000 and you distribute it to yourself, that's a dividend in a C corporation. Whereas in an S corp, that's just a distribution of profits out of your AAA account. And in a partnership, it's just a distribution out of your capital account, and you don't pay tax on it again. But as a C corporation, you pay tax as a dividend. Dividends are taxed at capital gains rates, so that's anywhere from 0 to 20%. So you have a double tax on that money if you do pull it out. The one thing that we talked about also is that at the individual level, state taxes that you pay are now limited as far as the benefit that you get from a tax standpoint. In a C corporation, those state taxes remain fully deductible. So if you pay them at the entity level, it's an entity level tax on income. It's deductible by the entity in calculating its taxable income. For you, on a flow-through, if that income flows through to you and you individually pay the tax on that, then it's going to be capped at that $10,000 a year, which may only include your real estate taxes for your house. So you may or may not get any benefit at all from paying the individual income taxes to the state, whereas a C corporation gets some of that deduction, or gets that deduction and gets some benefit from it. And then there is a code section that's section 1202. It's until now a little used tax code that says that if you sell qualified small business stock and it's a C corp and it's always been a C corp, then you may not have to pay tax on the capital gain from that. So it's a code section that's been out there for a lot of years. They've changed it. There used to be absolutely no benefit to it. Today there is potentially some very good benefit to it if it's structured correctly and you meet the guidelines of it. But that's only available to a C corporation, so that's one advantage of becoming a C corp. And then simplified tax compliance. We have some clients that are multi-level partnerships where the partnership makes money, they do business in 30 states, they send a K-1 to 15 partners who now get a K-1 in 25 different states, who have to file in 25 different states as well, or they've had tax consequences at least in all of those states. With the C Corp, you get it taken care of at the entity level and it stays there. Nothing flows through to the individuals, which is one of the reasons that you find a lot of venture capitalists don't like to invest in anything other than a C Corp because they don't want their investors to have have that compliance tax by filing in all of those states or keeping track of all of those different losses or passive incomes. The other thing that happens in a corporate structure is because nothing flows through, your basis in that stock is pretty much stagnant. Once you make an investment in a C Corp, it stays that way. With a flow-through entity, that basis changes every year based upon your income, what you take out, other things that flow through. So if you have an S Corp or a partnership, you or your accountant should be keeping track of what your basis is in that and updating that on an annual basis. Because that changes. It goes up and down as you make income and you take distributions. And where that comes in into play is if you sell the business or you get out of the business. So you have to keep track of that if you're a flow through, but that also typically keeps going up as you make money. In a flow-through structure, you can take those deductions. If you happen to lose money, if you have a bad year, then it can offset other income. So if one spouse has a business that loses, the other spouse has a good job, a W-2, then in a bad year, you can offset those losses up to the limitations we talked about earlier. It's also still remains a more efficient structure for people who are selling businesses. It's not as important with the new tax rates, but under old law, corporations didn't get capital gain treatment. So if your business was creating goodwill and you sold goodwill, at the corporate level, it would be taxed at 35%. In a flow-through entity, it would be taxed at a top rate of 20%. So you could get a lot of rate difference there. Under new law, it's going to be taxed at 21 or 15 or 20, depending upon what capital gain rate. You still have no capital gain at the C Corp level, but you do have that lower rate of only 21% as opposed to what was 35. Again, we mentioned the state tax deductions are capped. And then there's also a single layer of tax on distributed earnings. So when should you consider conversion? One, after a lot of consideration. This isn't something to go, okay, 20% versus 37%, let's do it, let's flip the switch. Some of the things to consider, what are you going to do with the profits? If all you take out of your S corporation is a tax distribution quarterly so that you can pay the taxes and a salary, then you might be a candidate because you don't need the tax distribution anymore if the entity's taking care of the tax. So you can retain that, pay the lower rate, grow your business faster because you're paying a lower rate and leaving it in the business. So if you're going to use those earnings to fund future expansion, retire debt, or to buy out shareholders, then that's one factor. You've kind of passed that. Next is, do you have a long-term horizon? You know, if you're looking to sell the business 5 years from today, we might go through a quick and simple calculation, but most likely that's going to come back and say, don't convert to a C corporation, because most businesses sell in what's in an asset sale. When you exit, you have two ways to get out, right? You can sell the stock of the corporation, or you can sell the assets. Most buyers want to buy the assets, most sellers want to sell the stock. Most of the time the buyers win because they're the ones writing the check. So most businesses sell in what's called a stock sale. And if you sell in a stock sale, then the corporation has taxable income from that sale. They're selling the assets, those assets are sold. Now you've got money in the corporation that you've got to distribute to the owners. You get that second level of tax. That second level of tax negates, we did one modeling, and it was like for 10 years, every year, the taxes were lower on the C corporation than they were on a flow-through, but if you assumed a sale in the 10th year, it wiped out all of those plus some, those benefits plus some whenever you sold and exited the business. So the longer your horizon, the longer you're going to hold the business or your family's going to hold the business before a taxable event, the more likely you might consider doing this. So again, future business sale does create double taxation unless you qualify under 1202, which is the small business stock. And again, most small businesses do not sell as a stock sale. The thing about a 1202 sales, code section 1202, is that you have to sell the stock. Can't be an asset sale. And then greater incentive in higher states because of that deduction that you get for the state income taxes. Wisconsin being one of the higher states that we deal with, that adds to the push to do a C corporation. So just a few comparisons. Again, if you're looking at the conversion, you ought to know the difference. So what is the difference? So pass-through entities, if you're a partnership, you're not an employee of the partnership. If you're an S corporation, you may be an employee of the partnership. If you're a C corporation, you are an employee, because really the best way from a tax standpoint to get money out of a C corporation is through paying you a salary. Fiscal year deposits, this is kind of an older concept that if S corporations don't have a calendar year, then they could elect to make a deposit. You don't have that with a C corporation. A C corporation can have any tax year that it wants because it's a standalone tax entity. So you can make a change, you can change your tax year and not be a calendar year taxpayer. If there's a business reason to do that, you see seasonal businesses that do that a lot. Flexibility in capital and profits structures. As far as getting money out, there's a lot more flexibility in a partnership or an S corporation in getting money out. In bringing owners in, you probably have more flexibility in a C corp or in a partnership. S corps are pretty rigid in what you can have, who you can have as a shareholder. Can't have another business as a shareholder in an S corporation. You can only have individuals or what I call fake individuals, like trusts that are treated as individuals. Also inflated AGI implications if you're a pass-through. And this is something I had to explain to my father-in-law. He got his K-1 from the dry cleaner business that he's in, and it's like it said he made $100,000. He's like, well, I didn't get that. No, but you got to pay tax on it. But I didn't get that. Well, you did because it's retained in the corporation for you. Well, what that does is that increases your AGI. It throws it on the top of all of your other income. So it may be taxed at the higher tax brackets. Then also, do you get the qualified business income deduction? A lot of businesses that get those, that lowers the tax rate, the effective tax rates, down off of that 37% that you kind of look at as the top rate at the individual level. The stepped up asset basis for partners. You know, this is one thing that if you have a business and it's at, say, the grandfather was the founder and he still owns 50% of the business, it's in a partnership. You know, one of the facts of life is that you're going to pass. We have new exemptions for how much can pass in an estate. When it passes in an estate, you get a stepped up value. You may get a stepped up value inside of the assets if you're in a partnership. That's another factor that goes into considering, is this the right decision for you? And then just a couple of other things, you know, the tax distributions, getting those out. You don't need to do that with the C corporation, but you do with the flow through. And then a year of loss. We talked about the limitations on a loss. On a pass-through entity, one of the things that we looked at this year was one of the candidates that we thought fit everything else, and then it's like, oh wait, they just did a huge investment that we're going to create a big loss on this year. We don't want to, have that loss in the C corporation where we could offset other income at the individual level rather than have it stuck in the C corporation. So we actually deferred the decision for one more year because of the fact that we thought we were going to have a year of loss this year. Other potential issues to consider: net investment income tax. If you're a C corporation, no way to avoid it. Dividends are going to be subject to it. If you sell it, it's going to be subject to the 3.8% net investment income tax. Also called the Affordable Care Act tax, the Obamacare tax, whatever you want to call it. Reasonable compensation. If you're going to be this is going to be an area that, again, is going to be a bigger point of emphasis within the IRS. When you look at what they're going to audit with the client, this is one of the first things they look at anyway, especially for S corporations, because one of the old planning is, okay, well, let's draw $20,000 of salary out and we'll draw $250,000 in distributions. Well, the IRS is going to look at that a lot closer the more that these net incomes and salaries come into play in giving you other deductions. So adequately planning that and documenting that is going to be more and more important. We've talked enough about state tax expense. I'm going to skip over that one. Step up and basis at the owner level. That continues to be a factor with the flow through. The top individual tax brackets, really we don't, when we're looking at this, if a business is not causing you to be in the top bracket, the 37% now, we're going to tell you it's probably not the time to do it. Because the greater that difference, the more likely it is to be worth it to convert to a C corporation. And then finally, if you use LIFO, auto dealers are one of the people that use that a lot. But if you use LIFO, that's a tax method that if there's a conversion, there are some tax implications to that. We have to factor that in as well. Some compliance issues as far as just how difficult is it to prepare tax returns. C corporations, you have one level of income, one level of flow through. You might have two levels of tax, but you have one level that it's computed in most years, except for your exit year. So the owner's business, we had an S corporation that took on an investor, became a C corporation. They went from both the corporation filing in 20 states and each individual owner filing in 20 states to now it's just the corporation. The owner gets a W-2 and he only files in Wisconsin. So that's when we talk about the owner's complexity, that complexity doesn't flow through when you switch to a C corporation. There's a few differences in entity governance that you would have to consider. Financial reporting implications, make sure your banks and everything are on board. Future tax legislation, we talked about that. The one thing that's certain is the tax law is going to change. It's an easy decision. It may be an easy decision now. You say, okay, well, 21 versus 37, I'm never going to take any money out. Well, that 21%, 3 years from now might be an easy target to make it 25. And then the decision might not be as certain. And then it might be 27 because we need something to balance some other budget area. So tax law is not stagnant. Tax rates are not stagnant. But this is a long-term decision. You're creating a C corporation, which is more difficult to get out of than an S corporation or a partnership. And then just some employee benefit considerations, cafeteria plans. More than 2% owners in an S corporation cannot participate in those. They can in a C corp. Executive compensation and equity awards. Equity awards are a lot easier in a C corporation than they are in an S corp or a partnership because you don't have to rewrite partnership bylaws. You don't have to worry about a second class of stock as you do with an S corp. Employee stock ownership plans are a little bit easier in a C corp, so if you wanted to consider one of those, it might be easier to do so as a C corp. So in summary, just as you look at the possibility of converting to a C corporation, if you've got a long-term business plan, you know what your succession plan is. That's the first thing that we ask a client when they come in and say, is a C corp right for me? Well, what happens to the C corporation? What's it going to be 5 years from now, 10 years from now, 15 years from now? And if in that time frame you're looking at selling, it becomes a more difficult decision. If it's passed down from generation to generation, then you don't have to worry about that exit tax that you do have to worry about if you're going to sell. It's not simply a rate difference. It's not simply looking at 21% and going, oh, that's what I want to be. It is something you should be thinking about. If you meet some of these situations, you got a long-term horizon, you take out an adequate salary, you don't take anything out except for tax distributions, and you have a succession plan, then maybe it might be the right move. But it is something that you want to make sure that you're considering all the aspects, you're getting good advice, you're getting good challenges, and not just somebody that says, oh, you want to be a C corp, that's a great idea, let's do it. let's talk, let's go back and forth and consider, is this really a right decision? Because you're changing your exit right now if you change to a C Corp. And then just looking into a crystal ball and saying, what do I think the tax code is going to do? Do I think there's going to be changes? Do I think the rates are going to go up? Do I think individual rates are going to go up? Do I think they're going to come down? And then finally, all this change that we've been talking about has been at a federal level. And now what are the states going to do? And that's probably one of the big questions that we have to answer between now and the end of the year, or we have to pay attention to between now and the end of the year, because most states haven't answered that question. In Wisconsin, as of right now, I'm going to skip down to the second point. Wisconsin is static conformity. So what the law was on December 31, 2017, that's what they're going to do. So you don't get all of those bonus depreciations for Wisconsin. You have to add all of that back in and then depreciate the property. So the old accounting joke about 2 sets of books, you got to keep 2 sets of books. So that's going to make a big difference in what your depreciation is. The other thing that we threw up there is a Supreme Court case that was heard, I think, last week, the Wayfair. And we throw this out there because this is going to be a big deal. And you've heard the president talk about Amazon and how they're ripping the states off. Well, in the state of South Dakota, this Wayfair was assessed sales tax based upon the fact that they sold through the internet into South Dakota. And Wayfair says, no, you can't do that because of the Quill versus North Dakota case from years and years ago. Well, the Supreme Court has agreed to hear this, and if South Dakota wins that, it may change how every state in the country defines what's called nexus, which means that if you're doing business here, we have the right to tax you? And if that changes in a negative way for internet businesses, for businesses that are selling product throughout the United States, it may change whether those are taxable from an income and from a sales tax standpoint. So that's something that we're keeping an eye on. You need to make sure that you're getting updates if you do business in a lot of states. And then finally, the state of Wisconsin, there's a new $100 tax credit, which I understand, I don't live in Wisconsin, so doesn't do me any good. But I understand you have to apply for that. There's going to be a new website that the state puts up. Has to be done by the end of May, and they're going to send you a check, right? Or brewer tickets. One of the two. So I know we've spewed a lot of information, and I do appreciate your time. And I practiced reading the disclaimer to you in a rap format last night, but I'm not going to do that. Are there any questions?